All right, folks. Hey, how you doing? Let's. There was a question about strike selection and how it's determined, why it's determined, and then why we do it that way. And we'll go through we'll go through an example. I think specifically we were talking about our position in Roku. So Roku is trading a little bit lower than where we got in. We got in at 63.81. It's come back off of its lows, which is good. But obviously, this is not a day trade, so we're looking at this in a swing capacity. So the question came up: well, a how do we determine what the what the strike was? So, oops, this is the wrong one. Hang on, I thought I grabbed the tool and I grabbed the tracker. Okay. So the first thing that we want to do is that the implied volatility is what gives us a reasonable price distribution, meaning that the implied volatility is derived from the price of the options. And the price of the options is a result of somebody finding a price cheap, somebody finding a price expensive, that same price, and thus they trade. That's why we have markets, price discovery. Okay, so given that implied volatility, like I said, we were trading about 40 or 50 cents higher when we got in. Let's just use that as the example. We were trading 63.92. We decided that we needed about a month, so we have 31 days left. And that implied vol at that time was 56.6. It's now 57.2, but we'll use this. So this gives us the price distribution over here on the left. This is the standard deviation move. So one standard deviation down will be 53.38. One standard deviation up will be 74.46, which is a $10.54 move, which translates into just about a 16.5% move. That, to be a little bit more conservative, you can use a lower confidence interval. So instead of targeting 53.38 to the downside, we would be targeting 54.59. But of course, this is a bullish signal. So instead of targeting 74.46, we wanted to target 73 quarter or something like that. So then when we went out into the option market, we see that up above there isn't anything really in that range. Now going out to 75, we said, boy, that's beyond a one standard deviation move. But if we were able to buy this and then we assessed our risk based on where we think is a reasonable place to target, well, we can do that, because just because we don't max out a spread doesn't mean that we can't have a valid play. So we have the 72.75 call spread, buying that, selling that. We know that that the max it could be is if we go to 75, right? Anywhere higher than that, it doesn't matter. We have a $3 wide call spread, so we can make $3 on our spread. We had to pay 50 cents, so we can net $2.50. We're getting 5 to 1, which is very, very robust. Let's put it that way. But we said, but again, targeting 75, I think you're kind of kidding yourself. So if you back it up and you say, well, what if we only go to 74, not 75? Well, now we're getting 3 to 1, still healthy. What if we only go to 73 half? Well, now we're getting 2 to 1. So still, it's a little bit low on that. But the full standard deviation move was what, to 74.46. So it's reasonable to target this. Well, since we don't have the 73 halves, the 74s, the 74 halves. But it's reasonable to put on a spread like this as long as you're honest with yourself of what you're really expecting to get from a reward to risk basis. So then the question was, okay, let's pretend that we know and we understand and we agree with how we came up with our targeted strike. I think the point was brought up. It makes me nervous that it's so far out of the money. Well, remember, well, what is one of the biggest reasons why we use options? Or we should use options. We do. A lot of people don't. But we use it for leverage. for the same investment, we're able to do more with options than we are, even with some other options, and certainly more than stocks or futures or something like that. So let's just use the example, and I'm just going to bring up a fresh worksheet here so we can see what we're talking about. So let's just say at expiration, and we'll say that the stock, in fact, got to 74. Okay, we could buy the stock. So we could buy the stock, and let's just say that we got in at we bought the stock at 63.90. Okay, we could have we could buy at the money option. At the money option is trading. If we're trading 63.30 here, if we bought the 63 half call, it's slightly out of the money, or I'm sorry, yeah, it's slightly out of the money, 63 half call. Let's just say that we can buy that for about, let's see, we'd have to go, it's trading a little bit higher. Let's just say that we would get in for a $4.30. Of course, actually we're 60 cents higher here, so 30 on that, 450. And then we could buy our spread, which was the 72.75 call spread. And we got that for 50 cents. Okay. Now, if our assumptions are right, and of course, we don't have a crystal ball. We don't know what is going to happen. All we can do is we have our technical trigger, which got us in, and then we have where the implied volatilities are. So, and that will give us our best guess. So let's just say at expiration, and the stock was not at 74. The stock was, oh yeah. And let's say we expire at 74, like we said. Okay, so the stock we know is going to be this, and let's say that we want to invest amount of $500, just arbitrarily. Okay, so if we have so the lots that we can do, if the stock is trading 63.90, well then how many shares of stock can we buy? Well, $500 divided by 63.90. We can buy 782. This is just a regular. We can buy 7.82 shares of stock for $500. Of course, we can't do a 7.82 lot. We have to do either a 7 lot or an 8 lot. But let's just say for theoretical example. Okay. If we buy the at the money call, and this is if it costs $4.50, we can buy a 1.67 because this is going to equal this divided by that times 100. Okay, so we can buy just over a 1 lot of at the money calls because each one of these is going to cost $450. Theoretically, we can buy 1.11111111. Or the spread, same thing, is going to be, we can buy what, a 15 lot, right? Because that's going to equal this divided by this times 100. Should be a 15 lot. Hang on a second. Oh, sorry. It's 10 lot because we're only investing 7. I had 750 in my head. It's only 50. So we can see. So then here, if we buy the stock, we go out, and we expire at 74, we are going to make $74 less whatever we paid for it, which is $63.90, times that. We're going to make 426 bucks. Excuse me. Let's parentheses here. There we go. Okay, we're going to make $79.03. Here, we are going to make, so we bought a one lot. This is going to be worth what at expiration? If we buy the at-the-money call, which I said was the 63 half call. 63 half, it's going to be equals 63 half, because that's the strike. 74 minus 63 half times that times 100. So we need to put some parentheses here, like this and this. So we are going to make $1,166.67. Everybody see where that came from? So then, but with the spread, we're going to the spread, which is the 72.75. We're going to make $2. $2 minus this times this times 100. So we're going to make $1,500 with that. So you can see how the leverage of doing this call call spread, how it maxes itself out. And we didn't even max out the spread. If we went out to if it did expire at 750, we'd make even more. So now, of course, this is at expiration. Whatever happens between now and an expiration, these things can trade wherever they want. And there's really no, I mean, we can model it. We can say, okay, you know, we're going to get this much of a move, and you know, implied volatility is going to do this. That's all subjective, not arbitrary, but subjective. But there is a truth at expiration. Your options are either underlying or they're zero. The stock is still the stock. If the stock goes to zero, you still own the stock for zero. Not a great thing. Okay, so that's the rationale between why we target, where we target, and why we do the spreads that we do. Now, of course, buying an at-the-money call, you're going to be profitable quicker because you bought an at-the-money call, and it has a much bigger delta. But remember, what we're trying to do is we're trying to unleash as much of the power of the options as we can. Okay, any questions on that? If there's not, then I'm going to stop the recorder, and then we'll go over. I know that there's some questions that popped up, or some stuff that probably shouldn't be part of this recording, but we'll go through that. So just give me a couple seconds. I'll scroll back through and see what questions I missed. Okay, thank you for that question. This is important stuff that we need to review. All right, thanks a lot.